Today, the 12th of August, 2026, the crypto world is digesting a genuinely tectonic shift. Vladimir Putin has signed a law that, from the 1st of September, will allow Russian retail investors to trade digital assets, but with an extraordinary condition: you can only buy Bitcoin, Ethereum, and the stablecoin USDT. Everything else is off the table. On top of that, there is a hard annual cap of just 300,000 rubles per person, roughly $3,750. That is not a typo. In a country that has over 140 million people, the government has essentially narrowed the entire investable crypto universe down to 3 tokens and a fixed budget. The question is not what is being allowed, but why these 3, and why now? The landmark legislation was signed into law just 6 days ago, and its details are remarkably prescriptive. Retail trading must go through intermediaries licensed by Russia's central bank. Before anyone can buy, they will have to pass an investor test designed to prove they understand the risks. Exchanges and depositories face strict licensing rules, and crypto payments remain completely banned. You still cannot buy a coffee with Bitcoin in Moscow. The law provides a transition period until the 1st of July, 2027 for market participants to get their licenses in order. This is not a chaotic experiment, it is a tightly controlled gate, and the central bank holds every key. This is where the analysis gets interesting. Russia did not choose these 3 assets at random. Bitcoin offers the deepest liquidity and brand recognition, Ethereum provides the backbone for decentralized finance and smart contracts, and USDT, pegged to the US dollar, gives a stable exit ramp and a proxy for hard currency exposure without directly holding dollars. By ring-fencing retail money into these highly liquid, globally tracked instruments, the state can monitor capital flows far more easily than if people traded thousands of obscure altcoins. It is, in essence, a controlled sandbox that keeps citizens inside a government-observable pipeline while maintaining a veneer of financial freedom. The 300,000 ruble cap further prevents crypto from destabilizing the domestic banking system. It is large enough to allow participation, small enough to avoid systemic risk. Perhaps the most unexpected headline buried in this story is that Russia has now leapfrogged the United States in comprehensive crypto rulemaking. While American regulators are still fighting over enforcement actions and jurisdictional turf wars, Moscow has delivered a full legal framework covering licensing, capital requirements, retail caps, and approved asset lists. For a nation often seen as reactive, this is a remarkably proactive move. It signals that Russia intends to harness crypto for cross-border trade and to offer a regulated alternative at a time when sanctions make conventional finance difficult. Other emerging economies will be watching closely. If this model works without crashing the ruble or triggering capital flight, it could become a template. Here is the takeaway you must sit with. Russia is not embracing crypto freedom, it is building a state-monitored digital asset corridor exclusively for Bitcoin, Ether, and USDT. For the average Russian, it means a tiny, sanctioned playground under the central bank's watchful eye. For the rest of us, it sets a precedent that governments can and will cherry-pick which crypto assets are socially acceptable. As the 1st of September deadline approaches, watch for the licensing announcements and the first wave of investor tests. If you hold a diversified portfolio of altcoins, ask yourself what would happen if your own government decided only 3 tokens were safe enough for retail hands. That is no longer a hypothetical question, it started today.